Okay. Oh, thanks, Lyle. Yeah, good afternoon, everybody. Thanks for dropping by and listening to our team's outlook here. As he said, Graeme Crosbie. I've been with FCC for actually 11 years now. I should probably update that bio. And yeah, I got a lot to talk about today. There's certainly no shortage of things to discuss here, but I wasn't sure if there'd be an MC or not, so I thought I'd just do a little deep dive on myself here before getting into the guts of the presentation. So yeah, I've been with FCC for 11 years, spent most of that time in risk management, but I probably should have always been in the economics group. I did my undergraduate degree at the University of Regina in economics, and then I did my master's degree in financial economics at Cardiff University in the UK. And while I was there, I also studied and received my CFA charter. And I grew up on a dairy farm west of Moose Jaw, so I'd be much more familiar talking about that content than say grains and oilseeds, but I'll do my best when I get to that there. As far as the team goes, FCC Economics, we've got myself and 3 other senior economists that cover all the primary production sectors across the country and also the agri-food sector as well. So we're a small but mighty group. We try our best to tackle what's the latest in each of those sectors that's relevant for producers. And like I said, there's certainly no shortage of things to talk about. And talking to folks here today, you know, the challenge of 2025, I mean, every year there's uncertainty, right? As farmers, you well know, there's risk and opportunities in every single year. You know, in an ideal year, a lot of those risks and opportunities are driven more by fundamentals and less so by politics and geopolitics, but that's the reality that we're dealing with today. And those, you know, those challenges also have implication for monetary policy, which I'll get to in a minute as well. But I'll start here. I had the unfortunate, a bit of an unfortunate timing situation where I had to have my presentation in on Friday, and then I got to speak here today on Tuesday, not knowing what, if anything, would happen yesterday. So my job's a little bit easier knowing that if and when any tariffs come, they're not, you know, in effect as of yesterday. But the threat is still there, and it's still real. President Trump has been quoted as saying, "To me, the most beautiful word in the dictionary is tariffs." And he's basing that on a point in time in American history, you know, back in the late 1800s and early 1900s, when you know, the structure of the American economy was very different, but yes, there were high tariffs in place at that time. I like to look at it a little bit differently. This is a gentleman named Henry George, who was alive and writing at the time of the late 1800s. And I find this quote very helpful because I think it summarizes at the highest level possible just the effect that tariffs can have. And he's quoted as saying, "It's very interesting that in times of war we blockade our enemies in order to prevent them from getting goods from us. In time of peace we do to ourselves by tariffs what we do to our enemies in time of war." So I find that summarizes the kind of the genesis of the tariff issue at the highest level. When we get down into the specifics, the mechanics of what could happen are not very straightforward. And I'm certainly not in the business of logistics, but I'm going to try my best just to summarize some of the more nuances that, you know, when it comes to the mechanics of tariffs. So a tariff that's applied, you know, the importer is the one charged a tariff based on the declared value of that product at the time. So if there is a tariff, importers have several options. They could absorb the cost directly, which would lower their margin, and I would argue that's the least likely outcome. They could find alternative suppliers if they do exist. They could raise their own prices further down the supply chain and try to pass on that extra cost. They could demand a lower price from the supplier to compensate for that tariff. Exporters themselves have similar options. Do they lower their prices to keep the goods attractive to the importer? And the complication, I think, it just comes, what is the costs, and in a sense, what is the distance of alternative supply if it's even available at all? So a colleague of mine in Guelph summarized it to me in this way, which is, if you're a pork plant in Pennsylvania and you're importing a large portion of your hogs from Ontario, do hogs exist in North Carolina? Could you source them? What's the cost to get them to your plant? That's just one example of some of the issues that people in the sector will need to think through if these come into fruition. And the loonie, which I'll talk to later on here in this presentation, the value of the loonie can change the calculation above dramatically. And overall, a weaker or lower loonie is a net benefit if you're an exporter, and I'll get to that in a little bit. So this gentleman here, this is Jerome Powell. He's the chair of the Federal Reserve. And the Federal Reserve is responsible for charting the course in the United States in terms of monetary policy. So they're responsible for setting the federal funds interest rate, the equivalent being the overnight interest rate here in Canada. And his job, too, has gotten more complicated in the last few months. So prior to, back in the fall, I should say, markets, and when I say markets, I mean investors, they were pricing in and expecting several Fed rate cuts in the year ahead for 2025. So you can see the federal funds rate, and the beginning of the year was, the high band was at 5.5%. The Fed began its own rate cutting exercise in September with a 50 basis point cut. And at that point in September, markets were expecting several more rate cuts to the point where the federal funds rate would zone out here at 3% by the end of 2025. But as the weeks went on and the outcome of the election, probabilities shifted, and then the election actually happened, the scripts kind of flipped here for the Federal Reserve. Markets are now only pricing in one rate cut in the year ahead. They have cut a couple times since September. The Fed funds rate is at 4.25% today. But you can see what's being projected right now is only one more rate cut by markets. And the Fed itself has said one, maybe two more rate cuts this year. And Chairman Powell himself said at the last rate decision, some members of the Fed are starting to incorporate some uncertainty into their voting. But he himself has said, quote, "When the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down." So the Fed has really course corrected here in the last few months in terms of where interest rates could go in the U.S. And that has implications for us up north here. This is Tiff Macklem. He's the governor of the Bank of Canada, who is responsible for setting our overnight interest rate. And so the bank, as probably most of you are well aware, started their own rate cutting exercise in June. On December 11th, which was the last meeting of the Bank of Canada, they cut the interest rate again by 50 basis points, so it's now at 3.25%. So since June, there's been a total of 175 basis points worth of rate cuts, which is pretty significant and largely a reflection of the slowdown in the Canadian economy that I think might have caught some of them off guard, just how much more fragile the Canadian economy currently is. And so why I began with the Fed and then moved to the Bank of Canada is just I want to highlight the importance of rate differences between our two countries. So all other things being equal, the higher interest rates in the Fed in the U.S., relative to Canada, that's going to put a lot of downward pressure on the Canadian dollar. And that's something we have seen, particularly since September when the Canadian dollar briefly flirted with the 75 cent level and is now below 70 cents. And one of, though not the only reason why that is just this difference in rates. So right now, we're over 100 basis points. The U.S. Key interest rate is over 100 basis points higher than ours here in Canada, which is a level we haven't seen since right before the financial crisis of 2008. So again, that's one of, but not the only reason why the Canadian dollar is in the state it is. We often, or in some circles anyway, talk about the weakness in the loonie, and to some extent that is correct, and that's the correct way to look at things. But the flip side of that is the strength in the U.S. dollar. Strength in the USD is at a multi-decade high, and you can see from this chart here, this is the U.S. dollar index from Bloomberg, so this is assessing the U.S. dollar against a basket of currencies, not just the Canadian dollar, but also the euro, the yen, the Mexican peso. And, since the Fed started tightening interest rates back in 2022, we've seen increased strength in the U.S. dollar, but it's really been on an upward trajectory for the last decade or so. Now, you would think, considering the deficits that the U.S. has had, the size of the actual debt outstanding, and all the things they've had along the way in the last decade, including debt ceiling negotiations and this and that the U.S. dollar strength might be a little bit lower. But we see that even when debt ceiling limits are being close to being reached, the U.S. dollar actually gets stronger as investors flee risk assets and go into perceived safer assets in the United States. So if we take a look at the Canadian dollar versus non-U.S. currencies, we maybe try to get a sense of how the Canadian dollar has been faring. And so this is just indexing values back to the beginning of January of 2023 and how things have trended in the last 2 years. And so, a little bit of depreciation relative to the euro. We're down 7% relative to the pound during that time. Looking at the Mexican peso, we were down quite a bit to the middle of last year, but the peso has really weakened in the last 6 to 7 months. And so we're essentially at the same exchange rate that we were at 2 years ago with the peso. Then we bring up the yen, and it's been a bit of a roller coaster, as you can see. But as of the beginning of the month, we've appreciated 14% against the yen. So, this is why, I bring up there is some weakness in the Canadian dollar, yes, but a lot of the impact that we see in the Canadian-U.S. exchange rate is due to U.S. dollar strength. I didn't mention it on the other slide, but the Bank of America said this is the most overvalued the U.S. dollar has been in at least 30 years. So something worth mentioning. Now, all that being said, we do see the strength in that U.S. dollar continuing and the weakness in the Canadian dollar, in the short term. It's hard to make a case for the loonie, peaking or breaking that 70-cent mark for a long period of time in the year ahead. It would take, I think, a significant weakening of the American dollar in order for that to happen. You can just see this is not a forecast, but just where we've been in the last couple of years, now below that 70-cent mark. And so again, it's gonna take some fading of U.S. dollar strength to see the loonie, appreciate significantly in the year ahead. I want to talk not just about overnight rates, but also bond markets, because I think sometimes we don't do a very good job in the profession of, relaying that, we talk about the interest rate as if there's only one interest rate in the economy, and that's certainly not the case. There's all types of rates in all types of different markets. So we'll start a discussion on the bond markets, because at the end of the day, depending on the maturity of the bond, that will form the foundation of the rate that you would ultimately see as a borrower when you go to your financial institution. So the first thing I want to point out is just the correlation between American and Canadian financial markets. Bond yields are really, really highly correlated between our two countries, and it's not the Canadian bond market that's driving the US bond market, it's obviously the reverse. So you can just visually see, going back to 1991, just how correlated the yields are between our two countries. You know, there's periods where the American yield is slightly higher, there's periods where ours is slightly higher, but overall, it's following the same trajectory. So I want to take a bit of time to just slowly walk through this, because I think it's super important, but it's not the easiest concept to wrap your head around. So what I've got up here is the yield curve. So on the vertical axis, we've just got different yields in a percentage, and at the bottom, different financial instruments at different maturities or different periods of time. So, you know, on the far left here, we've got the overnight money market rate, which is effectively the Bank of Canada's rate. 1 month T-bills, 6 month T-bills, these are just financial instruments, debt instruments that the government of Canada issues with different maturity dates. So what I want to illustrate is just, you know, on that far left-hand side, these yields, these rates are really influenced by the rates set by the Bank of Canada. But as we continue to go further right, you know, we've got a 1-year T-bill, we've got a 2-year Government of Canada yield, a 5-year yield, and a 10-year yield. And so the further right you go along this curve, the less these yields are influenced by what the Bank of Canada is doing, and the more they're influenced by US bond markets, the more they're influenced by inflation expectations, GDP or growth expectations. So less anchored, I guess, to what the Bank of Canada is doing the further right you go. So in March of 2022, right before the Bank of Canada began its tightening cycle and increasing interest rates, this is what the yield curve looked like. You know, again, near zero, which is where effectively the overnight rate was that the Bank of Canada controls. And the further along you go in time, a little bit more of a higher yield. So as of the beginning of this month, here's where the yield curve is at. So you can see this big gap from effectively 0 to 3.25%, again reflecting that 3.25 rate that the Bank of Canada controls. And on the 5-year, you know, again, which is, you know, if you're looking to get a 5-year fixed rate, for example, this yield here is going to be essentially the starting point for the rate you'd see as a borrower. We've seen that go up in the last 2.5 years, but not to the same degree that we've seen on the short end of the curve, about 150 basis points in that time. So the question looking ahead is, well, where do we see this yield curve towards the end of 2025? Yields change rapidly. They change every single day, so it's a hard thing to forecast. But assuming, you know, we'll see how the tariff situation plays out. But if there is no tariffs and if things don't go to pot, we do see, again, the Bank of Canada continuing to ease its interest rates, a couple more cuts in 2025. That'll bring this end down. And the yield curve, you know, there might be some wiggle room there on the farther end of the curve and for longer term rates, but not nearly to the degree that you would have on the short end. And the reason we say that, and the reason I started with US and Canadian financial market correlation, is that yields in the US have actually been on a tear since September, when the Federal Reserve started cutting rates. And this is a unique phenomenon, at least unique from the perspective of the last 30 years. What I've got charted here is it's the US 5-year bond yield, and on the bottom is just the number of days since the Fed began to cut interest rates, or cut its federal funds rate, I should say. So this isn't the first time that the Fed has increased rates and then decreased them. They're always moving things up and down. But historically, what we've seen going back to the late 90s is once they start cutting, bond yields either move sideways or in some cases outright decline 50 to 100 basis points. And this has absolutely not been the case in the last few months. The 5-year bond yield in the U.S. is up nearly 100 basis points in that time since September. This is a result of a lot of things and a lot of policy uncertainty, I would say. So one would be tariffs themselves. Tariffs can and do act as an inflationary tax, so to speak, on consumers. So if inflation in the U.S. is higher for longer, that'll mean the federal funds rate has to stay higher for longer, and that'll mean bond yields will stay higher for longer too. Some of it is fiscal policy related in the states. Trump has pitched tax cuts that'll have an incentive to spur demand, which will lead to more inflationary pressures in the U.S. Investors want to be compensated for that extra inflation because that devalues their money, right? So there's a lot of things and another thing, the third thing I want to mention too is, every year the U.S. has to roll over a tremendous amount of debt at the federal level. Anywhere from $7 to $10 trillion of debt is set to mature in the U.S. next year, which is a lot. And so the question really is, well, how are they going to, roll that over and fund themselves? And what type of interest rate are they going to have to offer to entice investors to actually buy those yields? That's also putting upward pressure here too. So, this is in effect keeping 5-year bond yields in Canada relatively flat. There's been no, this is a question I've had in the last few months. I thought the Bank of Canada was cutting rates. Why are 5-year fixed rates on offer not lower as well? This is the reason why. So if I had to summarize all that up on a macroeconomic front, what do we expect in the year ahead? I didn't have a chart to speak to it, but GDP growth in this country will be low. Our estimate is currently for 1.3% real GDP growth, which would be comparable to last year, which is positive, but not anything to really get excited about. That will help to keep a lid on inflation in this country, which will allow the Bank of Canada to continue to cut rates as it sees fit. We don't know the rate, we don't know the timing, we don't know how long they'll be in effect, but if and when that happens, GDP will suffer even further. And at that point, depending on what comes into effect and how things play out in terms of GDP growth and inflation, the Bank of Canada might be inclined to provide some more stimulus by lowering the overnight rate even further than we currently expect, which I just mentioned. So, we do expect, the Bank of Canada to continue and cut. The size and timing of cuts will be influenced by the Fed. It'll be influenced by any potential fallout as well stemming from tariff enactment. Canadian dollar, we expect it to stay low. It has the potential to go a little bit lower more than it has the potential to appreciate. And as I just walked through, longer-term fixed rates, for example, 5-year rates, they really have limited potential to move significantly lower than where they're at today. And I wouldn't be doing my job as an economist if I didn't provide some type of caveat to everything I just said. All of this is barring some major recessionary black swan events, which again at that point, all bets are off the table. So maybe I'm just looking at the time. Maybe I'll pause there for a minute. If there's any questions specifically on the stuff I just presented, I can answer them. I can also wait till the end of the presentation to field those questions as well. You can always find me in the back too when this is done. If you're a little gun shy and don't want to put your hand up, that's okay. Nope. The dollar declining today? The US dollar did? Okay. Yeah, this is, I figured something like this would happen where people had more timely access to the day's events than I maybe did. But if there's going to be a lot of violent fluctuations in the short term here for sure. I mean, even yesterday morning, when leaks started coming out that, these tariffs aren't going to be in effect day one like the threat was, and, they might be punted till who knows when, the dollar rose, like the Canadian dollar rose quite significantly. So it's going to ebb and flow like that, just as, in the face of uncertainty. I'm not sure, I haven't seen how the dollar has performed today, but I know that was the case yesterday until the February 1st date was thrown out, and then it kind of tumbled again. So I would just expect more of that type of news and, until there's some clarity on that front. Okay, I'll get into some more. I have about a half hour left. I'll get into some more ag-specific stuff. We'll talk a little grains and oilseeds, a little dairy, a little cattle, and a little hogs. And we'll start on the grain side. I may have insinuated this at the very beginning when I introduced myself a little bit. This is not certainly my area of expertise, but I've got some tremendous people on my team who cover grain markets on a daily basis, and so they helped me put this together. So I hope it's of some relevance here. So we'll go through a few key commodities here, and we'll start with corn. Corn being king, and I guess the takeaway here is, there's no supply concerns in the U.S. At this point. The January WASDE was released last week, I believe, maybe a week and a half ago. Production was 3% lower than 2023, but it was still a sizable crop, and record yields, I believe, approaching 180 bushels an acre on average. So when we talk about production and we want to look at supply, we don't just want to look at production and supply in isolation. We want to look at it relative to demand as well, right? You go back to anyone here, introductory macroeconomics, right? You got your supply curve, your demand curve. We'll take a look at it a little bit differently here. This is in a ratio form. So we've got on the vertical axis here a stock to use ratio. So these are estimated stocks at the end of the year relative to use or demand to try to get a sense of the balance in the market. So the higher percentage indicates that supply is in excess of demand. And the flip side, obviously, when that's lower, demand is greater than supply, which is more bullish. In 24, looking at 24-25, that stock-to-use ratio down from 23-24, but relative to some tighter years here at the beginning of the decade, the balance sheet is looking pretty strong in terms of corn production in the U.S. Now, interestingly, this just one of our senior economists who covers this stuff on a much more frequent basis noted this a couple of weeks ago. There might be some indications that there's some supply concerns globally. And so to walk you through that, we'll just look, at the bottom here on the x-axis, it's the same stock-to-use ratio. It's just global corn instead of U.S., excluding China, just because their production of corn, it never really gets into the world market. So on a global basis, we're seeing a stock-to-use ratio closer to 9% here in 24-25. We've also plotted here that against corn futures in U.S. dollar per bushel. Just to illustrate the relationship that generally speaking, when these stock-to-use ratios are tighter, as you get closer to the left-hand side, prices tend to increase, right? So what's interesting is, to us, and I hope relevant for producers in the room, is, we've got really tight global stock-to-use ratio here, comparable to 2012, 2013. But prices are really undervalued at this point. And the US dollar strength, which I was talking about earlier, I think is a big reason why. That strength in the US dollar is going to make it really that much more expensive to global importers to buy that American corn and import it. So that would also explain why, globally, stocks in other countries, Brazil, etc., their stocks are being drawn down while the U.S. is building up a little bit. And it all ties back to U.S. dollar strength. It's really, to me, this is super interesting. Like I don't focus this stuff on a day-to-day basis, but the macro stuff, the exchange rate stuff, I tend to. And, there is a bit of a feedback loop on the tariff front where, the country that tends to enact tariffs has their currency tend to appreciate, which makes exporting more difficult. So if you're President Trump and you're wanting to try to balance that trade deficit by, putting a tariff up to lower the amount of imports, assuming that you're going to export at the same pace, well, there's a bit of a feedback loop there, right? Where you're almost shooting yourself in the foot a little bit because your exports are going to get more expensive to everybody else buying it. So that's the theoretical framework, but I think to some extent we're seeing that in the corn market right now. Soybeans is a completely different story. Again, same stock-to-use ratio here for world soybeans. There is no tightness in the soybean market here. The USDA's estimates is a 33% stock-to-use ratio for 24-25. U.S. soy production was up 5% last year, and the USDA's latest estimate is a soybean crop of 169 million tons out of Brazil, which would be 10.5%, a 10.5% increase from 23-24. A 10.5% increase there represents about 18.4 million metric tons, which, right, for perspective, like that's more than our entire country produces in canola a year. They added that, or expected to add that in a single year. So things are a little bearish here on the soybean front. That's playing out here in prices as well. Just looking at the 5-year minimum values and maximum values from the last little while, 2025 is off to a sluggish year. Mostly a reflection of fundamentals, I would argue, with there being no supply concerns. But I also wouldn't rule out, just some uncertainty related to biofuel policy in the U.S. and what that would mean for vegetable oil, including soybeans. Canola is interesting for the current marketing year. For 24-25, China has been importing, it seems, every seed they can get their hands on. We've got here the year 2024, the cumulative amount of Chinese exports to China relative to the average from 2018 and 2023. Also just plotted the average on the time period 2019 to 2022 when we had those export restrictions placed upon us. So you can see here we don't have the December data yet, but we should end up surpassing 6 million metric tons just to China this year. Of all our canola exports for the year so far, 75% have gone to China. I think there's a good argument to be made that they're front-loading these imports because in September, as most people in the room are probably aware, they announced they were launching an anti-dumping investigation on canola exports. As probably a retaliatory measure for the electric vehicle tariffs that were applied to Chinese EVs from both Canada and the US. So it's likely they're just front-loading that, stockpiling it. We'll see what comes of that investigation. There was a similar spat, I guess, between China and Australia when it came to barley exports. That took about 18 months for them to come up with any type of decision. So we'd be about month 6 into that time period right now. So something could happen, I guess, in 6 to 12 months. Who knows? Domestic crush is actually at a record pace as well for the year. I think we've got a estimate of 11.5 million metric tons of domestic crush this year. So between strong exports, strong domestic crush, there's no shortage of this year's crop and people that want to get their hands on it. And you can see that in the stock to use ratio here. This is for world canola, rapeseed. European production was down this year, putting pressure on the availability of stock. So there might be some additional market access for canola into Europe as well. But again, between record exports to China, record domestic crush, I think the story now is more for what happens for the 25-26 crop. If there's restrictions that come out of China, what does that mean? What's the market look like for domestic crush in the year ahead? We've not had some good news there in the last week with Federated Co-op saying they're going to put their crush plan in Regina on pause. So we'll see what the next year ahead looks like. But again, at the moment, no shortage of markets for canola to go into. When we look at these stock-to-use ratios relative to the prices, that's that $600 to $650 dollar a ton range would be roughly in line with the historical relationship. Wheat prices, or the wheat market, real quick. We would argue wheat is being held back a little bit by the low price of corn in the U.S. We got the same stock-to-use ratios here. This is the U.S. all wheat stock-to-use ratio. So kind of neutral, no real tightness, no real excess. But I think for the reasons I described it before with the corn market, might be a little undervalued for the reasons I already discussed. Globally, wheat demand is exceeding supply. There's for the current year, but we're seeing no real price support, like I mentioned, and no real premium for higher protein wheat either. When we look at U.S. spring wheat futures, off to a pretty sluggish start for this year ahead. But there could be some upside to the wheat for wheat prices this year, just given, again, like I mentioned, the global balance sheet is expected to decline with global demand exceeding supply. I tried to, more out of curiosity than anything, I thought there might be tariffs that would already be enacted when I got on stage at this point. I was like, well, is there a good news story here in light of that? I guess one thing is just how diversified the cereal market is for Manitoba cereals. Just looking at the sum of exports from the last 5 years, I guess, going back to 2018. On a single country basis, the U.S. is the largest destination at 17%. But that's pretty low, really, especially compared comparable to some other sectors of the ag economy, the cattle market or the hog market. There's a lot more diversification there for cereals than for those other commodities. Input costs. I don't need to tell anyone in this room this. I'm not the one paying for everything to get the seed in the ground every year. So they are remaining very sticky. A lot of this data comes from the government of Manitoba. Every year they release a crop cost production guide, which individual producers can utilize to pencil out their own numbers. We also look at that data too, just to get a sense of trends and how prices, input costs have been trending in previous years. Some of these estimates are our own though, for fuel prices and fertilizer prices as well. So I mean, there's been a bit of relief, and I say a little bit relative to 2023, but overall there remains some stubbornness, including in the fertilizer markets. And particular phosphate prices have been very high relative to previous years. There's been no real relief there. So trying to combine all that into a big picture. We've got our prices and production on one side. We've got our input costs on the other side. What does the picture look like for profitability this year? So I've just charted here our team's estimate on profitability on a dollar per acre basis for some key crops grown in the province. These are returns overall over total costs except land, and I'll get to land in a minute. It's really difficult to come up with an average cost of land on a dollar per acre basis just because every farm is really just so different. The numbers themselves represent like a point estimate, right? But given all the uncertainty, I wanted to provide a bit of a range on prices. So the gray bars are representing, if prices move up or down, plus or minus 10%, how does that change the calculation? So for canola, for example, a 10-point decline, a 10% decline in prices would be, you'd be looking at maybe $85 an acre. If prices rose 10%, it could be slightly over 200. Peas appear to be the weakest of the group here, according to our estimates. And again, this is without considering land costs, which are always a point of discussion for sure. Using these same calculations, we try to come up, despite the difficulties, we do try to attempt to come up with an average cost of land, which is this fellow here. There's a lot of things that go into this calculation, including what land prices have done in the last decade, what's the projected interest rate, what's the percentage of land that is owned versus financed. So there's a lot of assumptions that go into creating a single number like this. This one in the middle is a little easier to calculate. This is just considering what is the cost of farmland today and what are interest rates looking like in the year ahead, so that we have a little bit more certainty here. So this is really just representing the marginal, the cost of adding a marginal acre of land to be about $140 per acre as of today. For the Western Manitoba region, I should point out. And the average rental rate, that's simply a 2% rate applied to the average cost per acre. So this is why, just given the variance here, even when trying to calculate an average, when we show these profitability projections, we try to exclude that land cost just because it's so different for each operation. Okay, I've only got 14 minutes here, so I'll quickly talk about farm equipment sales, but I don't want to miss out on the livestock stuff here. So equipment costs per acre continue to grow. And looking ahead to 2025, given lower commodity prices, tighter margins, still elevated interest rates, we expect sales of new equipment to be weaker than they have been relative to the last few years. And that'll have a spillover effect naturally into the used equipment market as well. This is year-to-date combine sales. I'm not entirely sure as of what point in the year for 2024, but in aggregate, there's been fewer sales relative to 22 and 23 in total, but we've noticed there has been more sales of larger classes of combines moving in 2024, just as some of the new, as some operations update their fleet and that gets dumped onto the used equipment market. We've seen sales pick up there, but overall the picture is of weakness in 2025. I'll take a few minutes to talk dairy. I'm not actually sure if we have any dairy producers in the room. Demand for dairy products has been very strong in 2024, and we're forecasting it to remain that way in 2025. Some of this is spurred by the increase in population that we've had in the country the last couple of years, but also for changes in preferences too. And so what these bars are showing, the bars themselves are actually just like total sales in billions of dollars. The number at the top here, 6.4%, that's sales growth year over year. The 7% number is the estimated increase in volumes, which are a little bit different, account for inflation. But either way, you can see there's quite strong growth in dairy product manufacturing in Canada relative to the last few years. So that's been bullish. That's been the key reason I'd argue behind the quota increases last year in the WMP and the incentive days that have been announced, including for this spring. For the year ahead, we know that there'll be effectively no change in the farm gate support price, which was already announced by the CDC. So, we're expecting average blended prices to trend sideways here in the year ahead with typical seasonality on a month-to-month basis. If you are a dairy producer and you're looking for a little bit of upside on the pricing front, this would probably be your best bet, because even within the structure of the supply managed system, not all prices for all components are set by the Canadian Dairy Commission. There are components that move with the world price. Class 5 products, for example, about 11% of butter weight is priced off U.S. prices. So, the USDA is projecting non-fat dry milk prices to rise about 5.5% this year, which would provide a very modest boost, I'll admit, to prices north of the border, but it would still be better than nothing. I hate to keep circling back to the U.S. and Trump and whatever, but it's inevitable that it needs to be addressed. The dairy sector was a target in the first Trump administration, so we've been asked, is this likely in the second? Is this likely to reoccur with Trump 2.0? Your guess is as good as mine. The only thing I could say here is, Trump 1.0 did negotiate the CUSMA agreement, which allowed for more access of the Canadian market. This, as you can see here, the limits that have increased each and every year as that phase-in period of the agreement was brought in. But last year, despite the volumes increasing, the allowable volumes increasing, the actual fill rate, the actual filled tonnage was either flat or lower in some cases. So if we look at cream, there's half of the negotiated limit that was effectively left on the table by the U.S. That could be for a number of reasons, but one likely reason is that milk production in the U.S. last year was pretty flat, and they had very strong export growth to non-Canadian markets. So they had other opportunities in front of them. So is this going to still irk the next Trump administration. I'm sure someone will get upset about it. I can't tell you if it's going to be in the crosshairs again or not, though. So overall, on the dairy side, we're expecting margins to be a little bit flat in Western Canada this year. Sorry, not flat. We're expecting them to fall relative to last year, but still, relative to some COVID years here, still be slightly better than average. Cattle markets, I've only got a few things to say here, which is good because I've only got 8 more minutes. But real quick on the supply side of things, the decade low cattle herd in Canada and then in the US too, going back to 1960, is by and large responsible for the high prices producers are seeing today. So the question is that likely to keep coming? Is it likely to be restrained still in 2025? The short answer is yes. What we've got charted here on the vertical axis is the heifer and cow share of the slaughter percentage of the preceding year. So what this 2025 number is showing is the percentage of female breeding stock that we're made up of in terms of total slaughter volumes. And so it's still last 2024 was the 3rd highest in recent memory. So given this percentage, what would we expect for changes in the North American beef herd? Well, we'd still expect a reduction of about 1.5 million animals for this year. So supply is going to. The takeaway here is there still has been a lot of heifers and cows that have been sent for slaughter for a variety of reasons. All is driven by the individual producer, but supply is still going to be tight for 2025. And so on the demand side, the question then really becomes, well, how much can the consumer be stretched? We've seen really significant increases at the retail level for beef. Cumulatively over the last 4 years, over 35% increase according to the Consumer Price Index. Substitute proteins, chicken has seen a sizable increase of its own, but not to the same degree as beef prices. And the pork industry, all things considered, pretty modest price increases in the last 4 years. Our research internally has shown that the preferences for beef they definitely exist, and we're actually pretty surprised that actual consumption has been as robust as it has in light of these prices. So it's really a question of whether or not that can continue in 2025. But overall, trying to again tie that all together in terms of profitability and margins. Again, we've got less fixed costs here, which is effectively land or pasture costs for the same reasons I described before. It should be a strong year in terms of profitability on a per head basis. Okay, a few minutes to quickly touch on the hog market too. Exports to the U.S., isoine exports to the U.S. so far this year, running pretty strong, just slightly behind the pace of 2021, where over 2.7 million piglets were exported to the States. So the trend line is pretty clear. There's been some degree of high reliance on the U.S. market. The uncertainty with tariffs, if and when they come in, arguably could have the biggest impact in the hog sector here. Just given, for Manitoba, in this slide here, just the volume of piglets that get sent to the U.S. for fattening and finishing. And also at a time where prices are really just, starting to recover from from some of these lows in particular in 2023. So looking at the export prices of those pigs, on a year-over-year basis, we've seen some double-digit growth in the latter half of 2024. So in October, prices were about $61 a pig relative to $46 in October 23. So they're really just starting to turn a corner here. So any enactment of a tariff would be, pretty detrimental to the sector. Hoping that doesn't happen. What does profitability look like? Which is down on the far right here. I've actually got two because I thought it was worth mentioning. So the darker blue is just return over variable costs. So, a little bit of positivity there, especially compared to the year 2023. But when you consider all expenses, particularly fixed expenses, we're still looking at or below break even. So I think I'm actually right on time. I might have time for one question. Our team produces content every week. It's published on our external website. If you don't want to have to go there on your own, you can sign up for the FCC newsletter at fcc.ca/newsletter, and our content will be included in that newsletter and get sent to you every week. So thank you very much for your time.
Thanks, Graeme. Thanks, Graeme. Any questions? I heard one thing this morning on a talk show where the States doesn't want us to drop interest rates anymore because it's going to affect our dollar going down, and they're going to be pissed off because America's going to want to buy from us. Have you heard that, or is
someone? Hello. Oh, there we go. It's kind of funny you mentioned that. I had someone actually earlier last week say, well, why doesn't the Bank of Canada just cut 150 basis points tomorrow and just steamroll the dollar?
But yeah, if you kind of find me up over.
Oh, we're back on this mic here. Graeme, maybe.
Sure. Hello? There we go. Okay. Is there a question out there? I'll answer your question first down here. So, someone floated out the idea to me that why doesn't the Bank of Canada cut from 3.25 down to 1%, and the dollar would tumble, exports would be supportive, and in addition to making the Americans further angry than they might already be, the financial market, believe it or not, does like things to be predictable as much as possible, and I would argue for the damage would be far worse to our reputation as a reliable place to invest. I think there's already enough uncertainty, and our investment rates are low enough in this country in aggregate that we wouldn't want to, potentially tarnish our reputation as a stable place to invest at a time when capital is really being sought after. So it would certainly do the trick, like it would flatline the dollar, but the benefits would not outweigh the costs.
Okay. Any other questions?
Okay, great.
I don't see any hands, so thanks, Graeme.
Thank you.